Ever wonder how people build real wealth without a huge salary? The secret isn't luck. It's one simple habit called a SIP, a systematic investment plan, SIP. Lets you invest small amounts regularly. You can start with as little as $50 a month. Today, I'll show you exactly how to start your first SIP, step by step. No jargon, no confusion. By the end of this video, you'll be ready to invest. Whether you're in the US or investing back home, this works. No finance degree needed, just 5 minutes of your time. Grab a coffee and let's build your money habit together. This is your complete guide to starting a SIP. Let's dive in.
A SIP is a fixed amount you invest in a mutual fund every month. It's automatic. The money moves from your bank on its own. Think of it like a subscription, but for your future wealth. Instead of investing one big lump sum, you spread it out. This reduces risk and removes the stress of timing the market. SIPs are most commonly used to invest in mutual funds. A mutual fund pools money from many investors, like you. That pooled money is invested in stocks, bonds, or both. A professional fund manager decides where the money goes. You just set your SIP once, and the system does the rest. It's simple, hands-off, and built for busy people like you. Now, let's look at why SIPs actually work so well.
Benefit 1. The power of compounding. Your returns start earning their own returns over time. Even small monthly amounts can grow into a large sum. Benefit 2. Rupee cost averaging, or in the US, dollar cost averaging. You buy more units when prices are low, fewer when high. This naturally balances out your average cost over time. Benefit 3. Discipline. You invest before you can even spend it. It builds a consistent habit, just like a gym routine. Benefit 4. Flexibility. You can start, pause, or stop anytime. There's no lock-in forcing you to continue if life changes. And you can increase your SIP amount as your income grows. Now, let's get into the actual steps to start your SIP. Step 1. Define your financial goal. Before you invest a single dollar, are you saving for retirement, a house, or your child's education? Write down the goal and the amount you'll need. Next, decide your time horizon, how many years you have. Longer time horizons let you take on a bit more growth risk. Shorter goals usually call for safer, steadier investments. A clear goal keeps you motivated when markets get bumpy. Use a simple SIP calculator online to see what you'll need monthly. For example, $200 a month for 15 years can grow significantly. Once your goal is clear, it's time to choose where to invest. Step 2. Pick a platform or app to invest through. Many US-based investors use global brokers or NRI investment apps. Compare platforms based on fees, ease of use, and fund options. Next, choose the type of mutual fund that matches your goal. Equity funds invest in stocks, higher growth, higher ups and downs. Debt funds invest in bonds, steadier, more predictable returns. Hybrid funds mix both, balancing growth and stability. Check the fund's past performance, but remember, it doesn't guarantee the future. Look at the fund's expense ratio. Lower fees mean more stays with you. A diversified fund spreads your money across many companies. This reduces the impact if one company underperforms. Once you've picked your fund, it's time to complete your paperwork. Step 3. Complete your KYC, Know Your Customer process. This is a one-time verification required before you can invest. You'll need a valid passport or government-issued photo ID. You'll also need proof of address, like a utility bill. As a US-based investor, you may need to confirm your tax status. Most platforms let you complete this online in about 10 minutes. You may need to do a quick video verification call too. Once approved, you'll get a confirmation email or notification. Keep your documents handy. You may need them again later. This step only needs to be done once, not every SIP. With KYC done, you're ready for the exciting part, setting your SIP. Let's move to step 4. Step 4. Decide how much you'll invest each month. A good rule of thumb? Invest what you won't miss. Even $50 to $100 a month is a great place to start. Next, choose your SIP date. Pick a day right after payday. This way, the money is invested before you're tempted to spend it. Choose your frequency. Most people go with monthly SIPs. Some platforms also offer weekly or quarterly SIP options. Set up auto debit so the amount is deducted automatically. Double check your bank details before confirming the setup. Review the summary screen: amount, date, and fund name. Once everything looks right, hit confirm to activate your SIP. Congratulations, your SIP is now officially active.
Step 5. Let it run and check in periodically, not daily. Checking too often can cause unnecessary stress and bad decisions. A quarterly or yearly review is usually more than enough. As your income grows, consider increasing your SIP amount. This is called a step-up SIP, and it accelerates your goals. Avoid stopping your SIP just because the market dips. Market dips are normal. Staying invested is what builds wealth. Set a reminder to review your goals once a year. Rebalance if your goals or timeline change significantly. Consistency matters far more than perfect timing. Small, boring, consistent habits build the biggest results. Now, let's cover a few mistakes you should avoid. Mistake 1. Stopping your SIP the moment the market falls. This locks in losses instead of letting your investment recover. Mistake 2. Investing without a clear goal or time frame. Without direction, it's easy to withdraw money too early. Mistake 3. Ignoring fees and expense ratios. High fees can quietly eat into your long-term returns. Mistake 4. Not increasing your SIP as your income rises. Your investments should grow alongside your earnings. Mistake 5. Putting all your money into just one fund. Diversifying across a few funds can reduce your overall risk. Avoid these mistakes and your SIP journey will be much smoother. Now let's see a real example of SIP growth in action. Let's say you invest $200 every month for 20 years. That's a total investment of about $48,000 over 2 decades. But with an average annual return of 10%, your investment could grow to around $150,000 or more. That's the real power of compounding and consistency together. Of course, actual returns vary and are never guaranteed. But history shows that patient, consistent investors are rewarded. The best time to start your SIP was yesterday. The second best time is right now, today. So don't wait. Open that app and start your SIP.
To recap, set your goal, choose your fund, complete KYC, set your amount and date, then stay consistent and patient. If this helped you, like, share, and subscribe for more. Now, go start your SIP. Your future self will thank you.